Well, folks, it's official. After Janet Yellen received a recommendation from the Federal Reserve and FDIC, a $25 billion bailout has been established for Silicon Valley Bank. I'm going to read some of these updates here. The U.S. Federal Reserve advances can be requested under a new program facility established until at least March 11th, 2024. All advances made under the program are made with recourse beyond the pledged collateral to the eligible borrower. That means anybody who borrows money through this facility needs to pay it back, or that bank could go bankrupt. Or let's say if a bank is acquired, basically an acquiring bank would have to pay off anything they borrow from the Fed. It sounds to me like we're using the discount window here to be able to do this. We've got a letter from the Fed as well. I'm just reading off some of these headlines here. Senior U.S. Treasury officials say Janet Yellen made the decision after the Silicon Valley Bank received the recommendation from the FDIC and Fed, and after consulting with Biden. Senior Treasury officials say Yellen and other officials continue monitoring the situation. They've also now taken, it looks like, custody of another bank, Signature Bank, in New York, and Signature Bank in New York has now been seized by regulators. Take a look at what we have here. Let's go on screen here and go through this together. The following statement was released by the Treasury Secretary, Federal Reserve Board, and FDIC chairperson. Today, we are taking a decisive action to protect the U.S. economy by strengthening public confidence within our banking system. This step will ensure the U.S. banking system continues to perform the vital roles of protecting deposits. All deposits at Silicon Valley Bank are now being insured and protected. In other words, no haircut for any depositor at Silicon Valley Bank. This is a move to try to prevent contagion. Now, they are saying that no taxpayer funding is being used for this sort of bailout. I think the idea is the Fed basically turns the printer on for $25 billion, and we're going to talk about where that money comes from in just a moment. But anyway, after receiving the recommendation from the boards of the FDIC and the Federal Reserve Board and consulting with the president, Janet Yellen approved essentially the resolution for Silicon Valley Bank that fully protects all depositors. Depositors will have access to their money starting on March 13th. No losses are associated with the resolution. We are also announcing a similar systemic risk exception for Signature Bank, which was closed today by the state chartering authority. All depositors of that institution will be made whole. All depositors will be made whole. This is, in my opinion, a de facto bailout, essentially, or it's an extension of all of the FDIC limits. Hey, Max, I need that to be closed. Come back and close that. It's all right, man. Finally, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. That's the discount window, folks. The U.S. banking system remains resilient and is on solid foundations, in large part due to the reforms that were made after the financial crisis. These are Dodd-Frank rules and that. These reforms confirmed today actions that basically demonstrate our commitment to the banking system, blah, 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 blah. Okay, so what do we have? Well, let's basically go through this together here. Essentially, hold on, a couple more updates. Senior Treasury officials continue to update steps to ensure financial systems remain strong. Senior Treasury officials will work with Congress and financial regulators to consider additional support measures as necessary, and strengthening the financial system. Okay, so what do we basically have? Well, basically what we have is this is just like COVID, folks, okay? Let me give you the COVID example, and then we're going to explain this current example. Okay, first of all, link down below, amazing. Coupon code for the programs on building your wealth, whether that's real estate investing, stock investing, perspective on finance, economics, you name it. Course member live streams every day the market is open. Elite Hustler courses on the weekend. Next coupon expires during St. Patty's week next week. So take a look at that before the price rises, because the price goes up over time. Okay, so during the COVID era, what did we have? In the COVID era, we basically had, hey, a lot of people might go bankrupt and stop paying their loans. So what did the Fed do? I'll give you one example. They said, hey, you know what? We will backstop all loans made for people's cars, basically. So they come out and say, I'll just make up a number. They'll say, hey, you know what? We're going to give $100 billion and we'll backstop all car loans or credit card loans or home loans or whatever. They basically wanted to create the impression that don't worry, banks, you can't lose any money by making loans. So keep lending to people. That's because during COVID, they thought, well, if we stop lending to people, then basically the economy will completely shut down and we'll have a worse financial crisis than 2008. So what happened today? Well, today, the Federal Reserve opened up a $25 billion facility. Now, based on numbers that I did this morning, it looked like the the Silicon Valley Bank, it looked like Silicon Valley Bank was probably going to be upside down by somewhere between 10 to maybe $25 billion. So it looks like as a result of that, the Federal Reserve has opened up a $25 billion facility. Now, we don't know exactly what the losses are at Silicon Valley Bank, because remember, they had about $211 billion in assets, but when you removed intangibles and mark-to-market losses, they were probably closer to maybe somewhere in the 170 to 190 level of actual assets, but they had debts around 195. That's why they were upside down. So what does this potential $25 billion essential bailout look like? And how do taxpayers not pay for that? Well, first of all, remember, the Federal Reserve is quantitatively tightening to the tune of about $90 billion a month. So really, they're taking $90 billion a month out of the system. But what they're doing with this new $25 billion facility is they're essentially opening up the discount window. The discount window is basically where banks can go to the Bank of New York and say, hey, look, man, I got all these bonds, and a lot of them are like commercial mortgage-backed securities or residential-backed securities. And on the other hand, I got a lot of people showing up at my bank because everybody's flooding and panicking. And they're like, yo, I need my money. And we're like, but we can't because all of our assets, if we were to sell them now, would be selling at a discount because you, Fed, have raised rates so quickly, the fastest rate increases that we've seen in the last 40 years. And the Fed's like, all right, how about this? Come to our window. We'll lend you the $25 billion. Maybe that's 15 for Silicon Valley Bank and 10 for Signature or another bank, whatever. That doesn't matter so much, right? But basically the way it works is you walk over to the Federal Reserve and you're like, yo, Fed man, I need to give these people their money. They're freaking out. Fed's like, all right, look, technically everybody over 250K doesn't get insured. But we don't want to cause a financial crisis. We just want to kill inflation. So how about this? We'll just say, instead of saying we're bailing out shareholders or the company, we'll close Silicon Valley Bank. But what we'll do is we'll create this fund. And we'll say, look, we got $25 billion here. We will give you that $25 billion. So we will give that to you, the Silicon Valley Bank. You take the 25. In return, what we want is we want $25 billion of assets. So basically $25 billion of potentially the CMBS or the residential mortgage-backed securities, basically the RMBS, although generally we drop the R. We want that to come to the Fed. So in other words, in the eyes of the Fed's like, look, we're going to be here for a while. We'll just hold your $25 billion of toxic assets because eventually they'll be worth $25 billion, even if that takes 10, 20 years. Eventually it'll be worth $25 billion. We'll take your 25 of assets. We'll give you the $25 billion of cash so you can cover your depositors so everybody's made whole. Nobody gets a haircut, which is great. Nobody gets a haircut, even though technically that does create moral hazard. And that's bad, right? I went into the Twitter spaces with Mario and all of them. I was fortunate enough to speak with them. It was fantastic. But this creates moral hazard because now it says that a bank that's funky, like Silicon Valley Bank, that's not mitigating risk by actually hedging for interest rate increases, it basically says, hey, you know what? You keep doing your risky lending. And one of the things that we all agreed on in the space is something that I brought up, that depositors do benefit from risky lending. Because if it weren't for risky lending, startups wouldn't be getting the lines of credit that from anywhere. Because they don't get the lines of credit from JP Morgan or Bank of America or other banks, but they can get them from Silicon Valley Bank because that's the startup bank. So you have looser lending, which benefits depositors, right? So the depositors ultimately win big here because the depositors get risky lending. You set a precedent that banks can go ahead and engage in risky lending, and guess who's always going to be there to bail you out? The Fed. Even if it's not even a systemically important bank, now all of a sudden the Fed is panicking. The Fed is blinking. The Fed is like, oh God, this is actually really bad. So let's create the bailout. we'll create the bailout, and what are we going to do with the bailout? We're going to backstop everything by 25 billion. Now, if somebody comes in and buys SVB, the bank, well, what happens? They still have to pay back the 25 bill. That's what the Fed's really doing here. Now, senior U.S. Treasury officials in time may look back and assess whether changes are needed to be made for deposit requirements on FDIC. Yep, that makes a lot of sense. Okay, so that's another way of basically saying, hey, like, maybe we need to charge banks more for FDIC. Maybe we need to increase the limits on FDIC so that way we can prevent this from happening. And we probably also need to look into regulation to prevent this from happening again in the future, because this was a disaster and created a substantial panic. Notice how the Fed is so panicked. They actually did this right before within minutes after futures started opening up. And before the Asian market opened. So really the Fed here is trying to say like, hey, whoa, hey, yeah, we need to be careful here. We're going to create this calm that we need right now. And ultimately, yep, we're here bailing out markets. Now, what else are we seeing? Well, Nick T's obviously tweeted about this. Nick T's obviously always tweeting about this. They're saying, some of the comments are like, hey, who's funding this? Hey, Max, I'm going to be done in about 2 minutes, okay? Who's funding this? It's really the Fed. They just create the $25 billion out of thin air. And then after they create the $25 billion out of thin air, they just take the IOUs, so it kind of looks like they took $25 billion. But the reality is it is somewhat inflationary, right? They could let the bank fail completely, which the bank is failing. Don't get me wrong, those shareholders are screwed. But they could let the bank fail, liquidate the assets, and if only 70 cents on the dollar come out, well, then depositors do get screwed. That leads to job loss, and then you kill inflation. You know what this actually tells me, though, is, wait a minute, we don't need a bank failure to kill inflation. It sounds to me like the Fed is convinced that inflation is actually under control. Look, we actually don't think we have a wage price spiral. This is a tell to me that the Fed's new lending facility not only helps Silicon Valley Bank make sure nobody has any losses, or Signature Bank, but also that facility will be available to other banks. Do I think $25 billion is going to be enough? Potentially not. That $25 billion could keep going. Heads up, that $25 billion set of pain could get worse. So in other words, we could still see people go, you know what? Too close for comfort. I'm getting out of the small regional banks, or maybe even potentially credit unions. They move to larger banks. What happens? You end up with more bank runs. $25 billion is going to be a drop in the bucket if we end up getting more bank runs. Talk about how this is a regulatory failure. Remember how regulation was loosened back in 2018 to where some of these banks were not required to go through stress tests. So again, Signature Bank in New York is now closed down. Fed is backstopping all Silicon Valley Bank depositors. So that's Roku, any of the small businesses and startups. Venture capital wins here. Pretty big announcement here from the Federal Reserve. This is a new emergency funding program. It's basically a bailout in disguise is what it is. Uninsured depositors get made whole. Let's see here. This is an alternative way of getting liquidity, an interesting way. It's not a bailout for equity owners. It's protecting the uninsured depositors. Fine. Yep. Okay, great. And there's going to be a little bit of a premium, as we saw in the press. Actually, we didn't see that in press release here. I saw it in the notes here. 10 basis point premium for borrowing from this facility. Okay, not a big deal. But basically, Jay Powell has done it. He's coming back in. Too long, didn't read. Silicon Valley Bank depositors will have access to all their money, and the Fed's going to create additional deposit or funding or make sure that's available as necessary. So there you have it. Check out the programs I'm building your wealth down below, and we'll see you in the next one. Thanks so much. Goodbye. All right, I'm done, Mr. Max. That was a